Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Europe podcast, available every morning on Apple, Spotify or wherever you listen. It's Friday, the 4th of April in London. I'm Caroline Hepker.
And I'm Stephen Carroll. Coming up today, stocks plummet. The S&P 500 suffers its worst drop since 2020 as investors flee risk assets.
Economists forecast that President Trump's so-called reciprocal tariffs will lead to a recession in the US.
Plus, trading blows. French President Emmanuel Macron calls on European businesses to stop investing in America.
Let's start with a roundup of our top stories.
A global sell-off in stocks is deepening this morning as Trump's tariff drive pushes investors to slash risk and pile into safe haven assets. The S&P 500 and Nasdaq 100 both posted their biggest one-day drop since 2020 yesterday, wiping around $2.5 trillion off US stocks. Meanwhile, Asian shares have now fallen to the lowest level in 2 months, with futures in Europe and the US pointing to further losses. The Bloomberg Dollar Spot Index also suffered its sharpest intraday decline since its launch in 2005, tumbling by as much as 2.1% on Thursday. Evercore ISI's head of technical analysis, Rich Ross, says the sell-off is turning into a crisis.
Whatever signs of optimism you've seen have been dashed. In essence, they've been bull traps. So I don't want to say that all is lost, but most is lost for the time being. And I think it's clear at this stage of the drawdown that this is not a garden variety 10% correction off the top, that clearly there are bigger forces at play here.
Rich Ross's sentiment is shared by the legendary investor Bill Gross, who's urging prospective dip buyers to stay on the sidelines rather than trying to, in his words, catch a falling knife.
Meanwhile, credit markets have also convulsed. Gauges of corporate bond risk surged on Thursday. US corporate junk bonds led the biggest slump in global high-yield debt since 2020. The risk-off spike is also affecting better-rated debt. For global investment-grade bonds, risk premiums rose to their highest level since September, as fears grow that the steepest US tariffs in a century could hammer economic growth. New American corporate debt issuance is also largely on pause. Meanwhile, traders are debating whether foreign buyers may scale back Treasury purchases. China and Japan are the largest overseas owners of US sovereign debt.
Markets have been on edge for weeks ahead of the planned tariff rollout. The trading day that followed the announcement turned out to be even more frenzied than expected. Bloomberg's Ewan Potts reports on a momentous day for trading desks.
All across the world, sell orders lit up on screens on trading floors from Tokyo to London and New York. Investors realising the sobering reality that Donald Trump really is serious about upending global trade. The Goldman Sachs trading desk said it was 9.5 out of 10 in terms of activity levels, with the heaviest selling from asset managers concentrated across technology and financial stocks. Hedge funds also offloaded long positions in bank stocks after piling into the sector ahead of the tariffs announcement. And perhaps unsurprisingly, it was a bad day for those with lots of assets. The world's 500 richest people saw their combined wealth plunge by $208 billion. That's the fourth largest drop in the Bloomberg Billionaires Index in its 13-year history. I'm Ewan Potts, Bloomberg Radio.
Now, as markets offer an instant verdict on Trump's efforts to reorder the global trading relationship, economists are sounding alarm bells. 76% of the 54 forecasters who responded to a Bloomberg survey after the announcement said that the imposition of sweeping tariffs only adds to the uncertainty about trade policy for business decision-making. Some 92% said that it raises the risk of a US economic downturn over the next 12 months. It is a view that's being backed by Bob Michael, global head of fixed income at JP Morgan Asset Management.
As things stand now, we're headed to recession. And it's very clear that this is a tax on businesses and households. Yes, Besson can talk about offsetting it with an extension of the Tax Cut and Jobs Act. But right now, a heavy tax has been applied to businesses and to households.
Bob Michael speaking there as traders bet that the Federal Reserve will be forced to cut interest rates and shore up a slowing economy rather than holding rates steady to keep inflation at bay. That sent the 10-year Treasury yield briefly below 4% yesterday as markets price in as many as 4 cuts from the central bank this year.
Despite the meltdown in markets, President Trump has defended his decision to slap countries with new tariffs ranging from 10 to 50%. Speaking on Air Force One, he said he believes that the economic turbulence will settle and left the door open to doing deals.
If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good. For instance, with TikTok as an example, we have a situation with TikTok where China will probably say, we'll approve a deal, but will you do something on the tariff?
Donald Trump there indicating he would be willing to offer tariff relief for China if Beijing approved the sale of the US operations of ByteDance's TikTok. The video app faces a deadline on Saturday for divestment unless Trump offers an extension as part of his efforts to broker an agreement. More tariffs on China mean goods heading to the US from the country will face an average levy of well over 60%.
French President Emmanuel Macron has urged EU businesses to halt spending in the US in response to President Trump's tariffs on the bloc. Speaking at a press conference following an emergency meeting with CEOs from sectors affected by the tariffs, Macron had this to say.
What's important is that we pause future investments or those announced in recent weeks until we've clarified things with the United States. Otherwise, what message would we send if we have major European players investing billions of euros in the American economy at a time when they are hitting us? So we need collective solidarity.
President Macron speaking there via a translator. He is clear that the EU shouldn't shy away from a strong response and has suggested the possibility of using the EU's anti-coercion tool to hit US digital services. The approach is reflected in Germany, where the outgoing Vice-Chancellor Robert Habeck has told reporters that, quote, the magnitude and determination of the response to tariffs must be commensurate with the threat. The EU's trade chief, Maros Sefcovic, will speak with his US counterparts later today.
The UK is receiving mixed signals from the US on whether the 10% tariff on British goods will be permanent. According to British officials, US representatives have told UK counterparts they'll discuss Britain's proposal to reduce tariffs, but added that the President may make 10% an indefinite global baseline. UK Trade Secretary Jonathan Reynolds told Bloomberg that talks are ongoing.
We will continue our work on a trade deal to remove the need for these tariffs and actually to deepen the existing relationship that we have, and that will remain the focus of our work here in the UK.
Jonathan Reynolds there speaking as conversations about a US-UK economic partnership, an idea previously backed by Trump, are expected to continue. Meanwhile, the threat of a global trade war looks set to push the Bank of England towards more rate cuts. On Thursday, traders ramped up rate cut bets and put the odds of another quarter-point reduction in May at almost 90%, up from 55% only a few weeks ago.
Now, those are our top stories for you this morning. So thinking about the markets right now, the S&P 500 was down about 5% yesterday. The Russell 2000 of smaller firms in the US plunging from its 2021 all-time high. US stock futures this morning are down again. The Nasdaq slumping 0.9%. UBS's wealth arm has cut its S&P 500 year-end target. European stocks suffered their worst day in 8 months yesterday. The US stock 600 sinking 2.6%. Again, stock futures are down 0.7% for the FTSE 100, down 0.4%. The Topics over in Japan down 5%, more than 5% this morning. The dollar also tumbled the most in at least 2 decades. And again, the dollar is down 0.3%. Looking at the bond markets, US 10-year yields are again below the 4 handle this morning, trading at 3.97, down by 0.6%. Those are just some of the markets moving today.
Well, in a moment, we'll have more on the continuing sell-off today and also look at how countries are scrambling to formulate their response to the moves by the United States. But plenty to read across Bloomberg today on the tariff story. We're continuing to watch the reaction. An awful lot of writing about the formula that the US Trade Representative's office used to try and come up with the how much, or the rate rather, of tariffs being applied to certain countries?
Yeah, absolutely. There was a formula that was published by the Trump administration to sort of justify the tariff imposition. Bloomberg reports that it is, quote, a formula that divides a country's trade surplus with the US by its total exports, i.e., pretty simple. They chose to print the formula, though, according to Bloomberg's Matt Levine, by also sprinkling in some Greek letters on their work to add visual interest. So this has kind of prompted quite a lively debate about this visual interest. Is it sort of a way of bamboozling people with a formula that looks more complex? Does it really come...
tongue-in-cheek says is a popular product in the financial industry, of adding a few Greek letters to spice things up.
Yeah, and that also, does it come with a kind of credible economic pedigree? Anyway, there's a whole debate around this and, how and why the tariffs are really being imposed. There's also it's also on social media. So if you want to see it highlighted, I had to look at the social media post to really understand the formula, to be honest.
You can read more from Matt Levine and from many of our colleagues writing about this subject across Bloomberg this morning. Bloomberg.com/opinion is where you'll find a lot of our best writing on the subject.
Now, a global stock sell-off continues amid fears of economic havoc as a result of Trump's tariffs. But the president says that he believes the markets will boom given time. Joining us now is Bloomberg's markets reporter Valerie Teitel. Good morning. How big a cataclysm is this for equity markets, firstly?
The U.S. equity market had a historic drop yesterday with the S&P 500 dropping nearly 5%, its worst session in nearly 5 years. And if we compare it to maybe some of the worst sessions from previously this century, it stacks up to maybe one of the worst days in the dot-com bubble. That was a drop of 5.8%. After the September 11th attacks, that drop was over 4%. Even when the U.S. was downgraded, that drop was around 6% when they were downgraded their credit rating. Even the worst days during the global financial crisis, one of them was in January 2009. That was a drop of 5.3%. So this is really a historic tumble for the U.S. equity market. And I guess the bad news looking on the screens this morning is that it does appear to be continuing with S&P 500 futures down 0.8%. Sectors wise, it was the worst day for the banking sector since the regional banking crisis. A lot of this also has to do with growth worries impacting banking stocks. We saw those credit spreads widening yesterday. Chip stocks had their worst day since March 2020. And if we look at the Mag 7, it's now entered a bear market. It's down over 20% from its peak. We also saw small caps enter a bear market as well. That's just another reflection of growth worries in the U.S.
Yeah, and the sentiment picture not much better looking at today's picture either. One of the questions, though, that markets are asking is what are the broader economic effects of the goal of all of this, which is a narrower trade deficit?
Yeah, I think this is going to be chewed over now for quite some time. I know you guys mentioned that formula that Trump used to apply these reciprocal tariffs was basically a product of the trade deficit with the U.S. And that is a clear sign to the market that he wants the trade deficit narrowed. And there can be many economic consequences of this. But one of them could be is that people will demand less U.S. assets. If we think about how dollars are recycled across the globe, the U.S. buys a lot of goods, sends a lot of dollars abroad when they do that. Those dollars abroad are then held in dollars and invested into U.S. assets. That is one reason why we have a government who's able to borrow so much money. There's a huge demand for treasuries. That is another reason why, frankly, the U.S. equity market is overvalued, because people want to hold on to these dollars, so they have to invest it in some way into U.S. assets. If we have that cycle slowing down at a certain pace, that really poses big major questions to just the basic valuations of the U.S. equity market if this trade deficit also closes the current account. I know that this is like a big economic theory to chew over, but I think yesterday was a big evidence of that, because we did not see the dollar strengthen in this risk-off move. It was almost a very hint of a beginning of the fact that U.S. assets have been so over-owned for so long. And now we could start seeing the unwind of that happen over maybe the next decade.
And whether or not reducing that trade deficit is actually a good idea, because the trade deficit is, a reflection of the power and the high quality sort of exports that the US has, versus, let's say, the kind of consumer goods that maybe other countries sell to the US. So whether there's a big question mark about whether that goal in and of itself is kind of a good one. In terms of other market moves, there is also a concern about the growth picture for the US now.
Oh, definitely. I think we saw that yesterday. Economists are amping up their percentage chance of the US entering a recession. I think that the key thing for the market moving forward, though, is frankly what we hear from Powell later today. Is he going to echo any of this pessimism? Because it was only a few weeks ago, in his press conference, he was talking about the resiliency of the US economy, about how the US economy is still solid. Will he in some way tamper that language? The market is going to be parsing over every word he uses and comparing it to the previous press conference. If there's any hint that maybe Powell himself is worried about the growth trajectory of the U.S. economy, that might embolden the market to think that they could cut rapidly at some time this year when we do see evidence of a slowdown show up in the hard data, which is something we haven't seen yet. It's seen in the softer survey data, but we've not actually seen it in hard data. And many people think that it's too early to even show up in the payroll print today. But an unexpected rise in the unemployment rate today could definitely be something that the Fed could hang its hat on in claiming that they need to do cuts sooner rather than later. So I think that's the big risk for the market today, is a weak payroll print.
Okay, Valerie Teitel, our markets reporter, thank you.
President Trump has defended his tariff plan, saying that it gives the US great power to negotiate. Whilst in Europe, France's President Emmanuel Macron has called on European businesses to stop investing in the US or pause. Joining us now is our EMEA News Director, Rosalind Matheson. Ros, good morning. So the shockwaves are spreading really far and wide, not just in markets, but everywhere really. How likely, though, is negotiation? What does President Trump want, and what's the likelihood of a possible deal?
I'm not sure I can answer the question of what he wants, but what I can say is that yesterday we had the officials in his inner circle saying, found out really being clear. They're saying Donald Trump is standing firm on this. He's not ready to change anything. But then Donald Trump himself overnight saying that, yes, if there was, quote, a phenomenal offer, he'd be willing to look at it. And what we do know is that we've got a lot of leaders around the world lining up to try and get on the phone to him, still thinking that maybe if they can just chat with him directly and make their case, perhaps they can persuade him to give them some relief from some of the tariffs that we're seeing coming on the reciprocal side. And so there does seem to be a window for that. And Donald Trump always leaves a bit of leeway for a deal. I mean, the interesting thing is that the one place he singled out in particular was China, saying that maybe if Beijing approves the sale of the US operations of TikTok, which is, of course, ByteDance, their social video app, that he might be willing to give them some tariff relief. And we know that he did come out pretty hard in terms of the tariff rates on China. And so that's one country that he's definitely signaled he's willing to make a deal with. But there does seem to be at least a window for some conversation, whether he'd be willing to drop the floor below 10%. That might be the bottom level of where he's willing to go. And again, if he does drop tariffs too far, then he's given too much away. So he needs to find that balance between maybe being willing to negotiate, but also holding some kind of line here on what he says he needs to do.
The conversation also happening among European Union countries about how they plan to respond. And we've learned that France and Germany are pushing for a tougher response.
Well, that's right. And we saw that yesterday with France coming out and urging the EU to look at potentially an EU-wide digital tax, digital services tax, so coming for US big tech in a slightly asymmetrical way. And then we had the French president, Emmanuel Macron, coming out and urging EU businesses to pause their spending in the US. I mean, it's a bit of a warning there, obviously, between Macron and Trump. You can't imagine that realistically companies would pause their investment plans simply on the back of what the French president said. But it does show that the EU is being a bit competitive here. They're gearing up potentially to do retaliation. And France and Germany in particular are pushing hard on that front. The question is, can they bring all the other European states along with them? We're already seeing some murmurs of difference within the EU about how strong to respond. So that's going to be the question, is can we maintain EU unity in this minute?
Meanwhile, President Trump says that the UK is happy with its treatment. But, of course, Britain does want to try to carve out that exemption. A word on the UK?
Well, that's right. So the UK is probably relieved that they got 10%. Well, the EU certainly got a lot higher. But they are still pushing to have this discussed. They are pushing to have a broader trade deal, perhaps, to replace this kind of tariff relationship. And Prime Minister Keir Starmer is saying he's confident he can get somewhere. What we do know from our own reporting in the conversations so far, it's still very woolly. It's unclear whether the UK is going to be able to get anything better, but absolutely they are amongst the countries that are trying.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.